Do you hear that? It's the sound of a ticking time bomb that could trigger an economic crisis. The billionaire investor Ray Dalio has warned of an impending financial crisis and recession in 2023. But who is Ray Dalio and why should you care? Join me as we explore the man behind the warnings and uncover what you can do to protect your finances. Ray Dalio's economic theory. Are you aware of the long-term debt cycle? If not, buckle up because you're in for a ride. Ray Dalio, the founder of Bridgewater Associates, coined this economic theory. He's been warning about a financial crisis and a U.S. recession in 2023. So what is this theory, and how does it explain the recurrence of economic problems? Let's dive in. The long-term debt cycle is a theory that explains the cyclical nature of debt and how it leads to recurring economic crises. He bases the approach on the idea that economies go through long-term debt cycles of 50 to 75 years, consisting of a period of growth and debt accumulation, followed by a period of debt deleveraging and eventually a recession. The cycle begins with a new era of innovation and productivity growth, which creates opportunities for borrowing and investing in new ventures.
That there has been a lot of creation of debt to make investments. So for example, banks, insurance companies, they borrow money at a certain rate, and then they go out and they make investments. And when those investments have lower returns, go down in value, as stocks and bonds have gone down in value, or they don't have adequate yields relative to the cost of funding those assets, you have everybody losing money. And that is a pervasive situation.
It leads to a period of change as the economy booms, and people feel confident in taking on more debt. It is where the fun starts, right? But as the cycle progresses, the amount of debt in the economy continues to increase, eventually reaching unsustainable levels. It leads to a period of deleveraging, where people and institutions try to reduce their debt levels, causing economic growth to slow or even reverse. During this period, asset prices fall, unemployment rises, and the economy experiences a recession. You might think, why can't we just stop taking on so much debt? Well, it's more complicated. According to Dalio, debt is necessary to fuel economic growth and innovation. However, as debt levels rise, they become increasingly unsustainable, eventually leading to a crisis. In other words, the cycle is an unavoidable part of the economic system, and it's crucial to understand how it works to prepare for inevitable economic downturns. So what does this mean for you and your finances? It means that during that period of growth, it's essential to be cautious and avoid taking on too much debt. Preparing for the eventual downturns is crucial to saving money, diversifying your investments, and having an emergency fund. In conclusion, Ray Dalio's long-term debt cycle theory provides insight into the cyclical nature of debt and its role in economic crises. It's an important concept to understand, and by being aware of it, you can take steps to protect yourself and your finances.
That balancing act is difficult. And there's this big supply-demand means that there's a need to borrow a lot of money. If you look ahead and you say how much money needs to be borrowed by the Federal Reserve, by the government, in order to deal with this situation, big deficits, that means they have to sell debt. There's a supply-demand imbalance. In other words, those who want to buy debt, what are they going to buy it for? They need to have a high enough real return. If they don't have a high enough real return, they can sell the debt or their debt that they're holding rather than buying that.
Warning signs of an impending economic crisis. Have you ever had that gut feeling that something just isn't right? That feeling you get when you know something big is coming, but you can't quite put your finger on it. Well, that's the same feeling that Ray Dalio has been experiencing lately, and he sounds the alarm bells about an impending economic crisis. Dalio has warned about a potential economic crisis for a while, but his recent views have become increasingly dire. He's been vocal about it on social media, sharing his opinion on the warning signs of an impending economic crisis. One of the warning signs that Dalio has identified is rising interest rates. In a recent tweet, he stated, "I hear it commonly said that inflation is the big problem, so the Fed needs to tighten to fight it, and everything will be good. It is both naive and inconsistent with how the economic machine works. Higher interest rates can increase borrowing costs, harming consumer spending and business investments." Another warning sign that Dalio has highlighted is increasing debt levels. He believes the world is experiencing a debt supercycle, where countries, companies, and individuals accumulate more debt than they can handle. In a recent article on LinkedIn, he stated, "I think we are in a pre-bubble stage that could go into a bubble stage. Debt growth is accelerating at a time when asset prices have already bid up." In addition to these warning signs, Dalio has also expressed concern about the political and social tensions in the world. He believes these tensions could potentially lead to a global economic crisis, stating that geopolitical risks are rising. So what do these warning signs mean for you and me? Well, if an economic crisis were to occur, it could have a significant impact on our daily lives. We could see job losses, a stock market crash, and inflation. It's essential to watch these early warning signs and prepare for the worst-case scenario. For example, you could start by paying off your debts, building an emergency fund, and diversifying your investments.
So if you have an inflation rate that's 2 or 3%, and you're earning 1%, and you have to pay taxes on that 1% or the 1 or 2% that you're going to get, you're going to get taxed essentially at 2% a year, and that's going to be a problem. So you have to move into assets that are other assets that are going to do better over a period of time. And when you do that, the most important thing I can convey to you is to diversify well. Because I can guarantee you that one of those assets, and you won't be able to pick the right one, will be disastrous in your lifetime.
While no one knows precisely when an economic crisis will occur, the warning signs are there, and we need to take them seriously. Let's stay informed and prepared. We can weather the storm together. Impact of economic crisis on the U.S. economy. Picture this. You wake up one morning to check your bank account, only to find out it's in the negatives. You've lost your job, your investments have taken a hit, and your savings are all but gone. This scenario may seem far-fetched, but it's more common than you might think. Meet Sarah, a 30-year-old mother of 2. Sarah had a well-paying job and could provide for her family comfortably. However, when the pandemic hit, Sarah's company went under, and the company laid her off. Sarah, like many others, struggled to find a new job and fell behind on her bills. Her savings account, which she had worked so hard to build, was completely depleted. Unfortunately, Sarah's story is not unique. An economic crisis can have devastating effects on individuals and families. Job losses, as Sarah experienced, are a significant consequence of a recession. Companies financially struggling may need to downsize or even shut down completely, leaving their employees out of work. Stock market crashes are another potential impact of an economic crisis. When the market crashes, investors lose money, and many companies may struggle to stay afloat. It can lead to even more job losses and affect people's retirement funds and other investments. Inflation is yet another potential impact of an economic crisis. When the economy is struggling, the value of money can decrease, leading to higher prices for goods and services. It can make it even more difficult for families to make ends meet, especially if they are already struggling due to job losses or other financial challenges. The potential impact of an economic crisis on individuals and families is more than just theoretical. In fact, during the Great Recession of 2008, unemployment in the U.S. peaked at 10% in October 2009. Additionally, the S&P 500, a stock market index, lost nearly 50% of its value between 2007 and 2009. And while inflation did not reach astronomical levels during the Great Recession, prices rose, making it more difficult for families to make ends meet. As you can see, the potential impact of an economic crisis on the U.S. economy is significant. It's essential to be aware of the warning signs and to take action to prepare yourself and your family, whether that means building up an emergency fund, diversifying your investments, or simply being mindful about your spending. Every little bit helps. So take action today to protect yourself and your financial future. Ray Dalio's recommendations for surviving an economic crisis. You may think, I don't need to worry about a recession, everything is fine. But let me ask you, have you ever heard of the saying, hope for the best, but prepare for the worst? Well, that's what we're going to be doing today. So what does Ray Dalio recommend we do to prepare for an economic crisis? First and foremost, he stresses the importance of diversifying investments. You may think, I already have investments, so I'm good, right? Not quite. Ray Dalio suggests spreading your investments across multiple sectors and not relying solely on one industry. For example, instead of investing only in technology, consider investing in healthcare, energy, and other sectors. This way, if one drive takes a hit, your portfolio won't take as significant of an impact. Now let's talk about the elephant in the room, emergency funds. Raise your hand if you have an emergency fund set up. If your hand isn't up, don't worry, you're not alone. According to CNBC, almost 60% of Americans have less than $1,000 in their savings account. Yikes. Ray Dalio recommends having at least 6 months' worth of expenses saved in an emergency fund. If you lose your job or a recession hits, you have a financial cushion to fall back on. But wait, there's more. Ray Dalio also suggests reducing your debt as much as possible. It means paying off credit card debt, car loans, or any other debt you may have. Why? Because debt can weigh you down during an economic crisis. If you have a lot of debt, you may need help to make ends meet during tough times. You may think, but how do I even start paying off debt? Here's a helpful tip. Start with the debt with the highest interest rate. By doing this, you'll save money in the long run. Another valuable piece of advice is to create a budget and stick to it. This way you know exactly where your money is going and where you can cut back.
Calculate how many days, weeks, months, or years you can live on your saving. The money, that means money.
Yeah.
Now, at that moment that you don't want it, you have savings. That means I want savings. Okay. Now you got savings. So the next thing inevitably that's going to come at you is, where do I put it? Mm-hmm. And then you get your choices, and then you experience it and you learn.
To wrap things up, remember to diversify your investments. Have an emergency fund and reduce your debt as much as possible. These tips can help you survive an economic crisis and become more assertive on the other side. Please take your time. Start preparing today. And if you're interested in starting to invest in assets and stocks, I've got an exciting offer for you. I've included a link to start commission-free trading in the video description. That's right, you can begin investing without worrying about pesky commissions eating away at your profits. You've heard it before, be prepared for anything. But when it comes to the possibility of an economic crisis, do you know what that means? Let's face it, most of us don't want to think about a recession. It's like a financial monster hiding in the closet, waiting to jump out and take our money. But what if I told you there's a way to face that monster head on? That's right. It's time to take control of your finances and prepare for the worst. All right, folks, here's a quick recap of the main points we covered. Ray Dalio's economic theory explains how debt buildup can lead to a financial crisis, and he has identified several warning signs to watch out for. These include rising interest rates and increasing debt levels. The impact of an economic crisis on the U.S. economy can be severe, leading to job losses, stock market crashes, and inflation. So what can you do to prepare? Ray Dalio has recommended diversifying your investments and having an emergency fund. Start by taking a close look at your finances and creating a budget. Ensure you have enough savings to cover at least 6 months of living expenses. Consider investing in stocks, bonds, and other assets less likely to be affected by an economic downturn. And remember, it's always early enough to start planning for your financial future. Now, this might sound overwhelming, but don't worry, we've got you covered. I dedicated my channel to providing you with the latest financial news, tips, and strategies. So if you still need to, hit that subscribe button and turn on notifications so you get all the updates. And if you found this video helpful, please give it a like and share it with your friends and family. Let's help each other prepare for the potential economic crisis ahead. Lastly, remember to check out our next video on the end screen. It's packed with even more tips and strategies to help you thrive during these uncertain times. Trust me, you don't want to miss it. Thanks for tuning in, and until next time, keep hustling and stay financially savvy.